Another busy year is in prospect for the investment sector of the Northern Ireland market, following the completion of approximately £400 million worth of sales in 2015. One of the key differences in 2016, however, will be an anticipated lower level of deleveraging as the market moves back to more normalised trading levels. As deleveraging efforts wind down, it is inevitable that a greater proportion of transactional activity in the investment market in Northern Ireland will emanate from secondary trading, as some recent buyers, such as private equity firms, implement their asset management and exit strategies. And many of the assets and loan portfolios purchased over the last number of years are retraded and refinanced. We also expect to see some continued activity in terms of refinancing and loan sales in 2016. However, with the investment market in the region now predominantly core as opposed to opportunistic, it is clear that in addition to acquiring additional assets, investors are increasingly going to focus on maximising income generation from existing assets and exploring potential development opportunities. In addition to an increasing number of investors seeking to move up the risk curve into alternative sectors in order to enhance returns, we expect much greater emphasis on more higher yielding development projects as the year progresses, with particular focus on office, hotel and student accommodation schemes. We therefore forecast an increase in forward funding transactions this year. We look forward to continued improvement in debt funding for prime income-producing investment properties over the course of the next 12 months. However, we expect that the availability and cost of debt funding for secondary assets will remain constrained and prohibitively expensive for some time yet. We do expect that the availability of debt funding for speculative development will remain challenging, other than where pre-lettings have been secured. With the exception of the offices sector, which may see yields strengthening a little in the second half of the year due to rental growth expectations in this area, we expect that yields in Northern Ireland will remain relatively stable over the course of 2016. As a result, the region will remain comparatively attractive relative to other regional cities in the UK, which in turn should drive continued appetite for prime investment opportunities. With occupier activity predicted to benefit significantly from a proposed reduction in corporation tax in the region after 2018, Northern Ireland will offer a further compelling investment opportunity for investors, including some new overseas entrants. The Northern Ireland investment yield arbitrage compared to other UK regions, coupled with the low interest rate environment, will continue to fuel investor activity over the short to medium term. When interest rates start to increase, as they ultimately will, they are not expected to rise dramatically. The gap between bond rates and commercial real estate returns will therefore remain elevated for some time yet. We are now entering a period where the investment market will be more focused on generating returns from income and rental growth, which is ultimately more attractive to long-term investors than a cyclical market driven by the weight of capital.